Okay, I can see we are on the hour. Let's get going. Thank you and welcome everyone to our 2011 Oregon Tax Law Update. This is just a quick 1-hour review of what's new and a little bit of a refresher on some of the things that, well, aren't new, but probably you should be reminded about anyway. Because things were pretty quiet at the federal level with federal changes, Oregon's been quiet as well, and the big exciting thing that happened for 2011 tax law with Oregon really took place during the 2011 tax season. And what happened was that in December of 2010, a lot of last-minute legislation was passed at the federal level. And then Oregon, which does have an automatic connect in most cases to federal law, doesn't actually automatically connect until the Oregon government or the Oregon legislature convenes and decides that it will in fact connect. And the Oregon legislature wasn't scheduled to convene until February of 2011. So as we hit the 2011 tax season, as tax practitioners, we did not know what the Oregon law was going to be for 2010 tax returns. And there were specific issues with the educator deduction, bonus depreciation, Section 179 depreciation, and the tuition and fees deduction. Those were the big things that were what-ifs. We didn't know what was going to happen. So 2011 tax season was kind of a mess because we were delayed on the filing of some federal tax returns because IRS computers needed to be updated to even take them because tax laws were passed so late in December of 2010. And on the Oregon side, it wasn't even a matter of getting the computers updated because the Oregon Department of Revenue didn't know what the law was going to be for 2010 tax returns, and we were already into the 2011 tax season. So in any event, of course, the legislature did finally meet, and it did reconnect with most of the federal changes, but not all. And what was interesting is that the legislature decided to connect for some things in 2010 and connect for other things beginning in 2011. So we have a disconnect for certain differences in federal and Oregon law for 2010 and for 2009, but we're reconnected again in 2011. So just being kind of paying attention to those items is rather important because it's going to impact how we prepare Oregon tax returns for a few years in the future. And the specific area I'm talking about is depreciation differences. So let's get going with today's class. I'm on the first page of the manual, and the introductory line says that Oregon is tied to the December 31, 2010 federal definition of taxable income. The reason it's tied to the federal definition of taxable income as of 2010 is because when the Oregon legislature met in the winter of 2011, it connected to that date. But what that means is that Oregon could start to differ again over 2012 until it reconvenes and matches any changes that might occur in 2012. Having said that, Oregon always says it automatically will adopt any future federal law changes, but it only adopts them after it's convened and decided to adopt them. So it's kind of confusing language. Now, having said that Oregon will automatically adopt and has adopted or tied into federal law, there are two important exceptions to the December 31 tie-in. They include the Internal Revenue Code Section 139A for the federal subsidies for prescription drug plans and IRC Section 199 for income attributable to domestic production activities, also known as Qualified Production Activity Income, or QPAI. In these two areas, Oregon does not conform for 2011 tax law. Income under these sections is exempt on the federal return, but if you have either of these types of income, you will have an addition to income on your Oregon tax return. Also, there is an important form change for 2011. Beginning in 2011, there is no more short form Oregon 40S. So for the 20 years I've been in taxes, there's always been this form 40S. Well, it's gone. All Oregonians who are full-year residents of Oregon must now file the full-year Oregon Form 40, which means they will need to attach a copy of their federal return, 1040, 1040EZ, or 1040A. And here, of course, is the new Oregon Form 40 for 2011. No major changes to speak of. It is the same form as a year ago, except the number, of course, at the top has changed. And when we get down to entering our standard deduction in the instructions and our personal exemption credit, the amount will have gone up by $2. So the exemption credit in 2010 was $177, and for 2011, it's $2 more. Woohoo! So here are the filing requirements for Oregon full-year residents. Do I need to file an Oregon tax return? And you will need to file an Oregon tax return if your income exceeds, that is more than the amount shown in this column based on your age and your filing status. So the first thing we see is if you are a person who can be claimed as a dependent of another filer, Oregon's filing requirement is the greater of the earned income plus $300 or $950. And that can be a little bit confusing to people who are new to taxes. Sometimes people who've been at it for a while do get confused by that. But I'm not going to be going into the details more than that for an explanation. We do have that in some of our continuing education courses. Going on to the next category, we have single. If you are under age 65, then you are required to file an Oregon return if your income is $5,345 or more. And you can add $1,200 to that filing requirement if you are age 65 or older. For married filing joint, if you are both under age 65, you are required to file if your income is $10,700 or more. And you can add $1,000 to that filing requirement if one of you is at age 65 or older, or $2,000 if both of you are age 65 or older. Filing requirements for married filing separate are essentially the same as for single. And for head of household, you have a filing requirement that's slightly higher. Now, one of the things I should point out is that the filing requirements on the Oregon return are lower than the filing requirements on the federal return. So it's entirely possible to have an individual who is required to file an Oregon return, even though they are not required to file a federal return. And that would be because their income is more than the amount shown on the Oregon table, but less than the amount necessary to trigger federal filing requirements. On the next page of the manual, we come to the filing requirements for non-residents and part-year residents. And the interesting thing about the filing requirement for part-year and non-residents is that the filing requirement is equal to the standard deduction. So if you look at here, it says that the filing requirement for a single person is $1,980. Well, that is the standard deduction for a single person for 2011. And for a married couple, that standard deduction is $3,960. And for head of household, that standard deduction is $3,185. And we're moving on now to the Oregon Schedule ASC. This schedule is not new anymore. It's relatively new in the history of Oregon filing, but it's been around for a good 5 years at least now, I'd say. The purpose of Schedule ASC is to enable a person to identify that they are claiming more than one other addition, more than one other subtraction, or more than one other credit from taxes paid to another state, or more than one other kind of credit on their Oregon return. They need to identify the credit or addition or subtraction that they're claiming with a code, and then enter the amount of the addition, subtraction, or credit they are claiming in the amount column. And we are going to be giving out a series of passwords today, actually only 2 in today's class because it's such a short class, a 1-hour class. The first password of the day is Seaside. And just as a reminder, our passwords are always lowercase with no spaces. So at the end of today's class, when you go to take your password test, you must enter the passwords as we've given them to you. And password number 1 is Seaside, S-E-A-S-I-D-E. Jot that down, and at the end of today's class, when you go take the password test to prove that you sat in and attended, you will enter that as password number 1. For tax year 2010 returns, a number of federal tax breaks were set to expire and were extended shortly before the end of the year. With the advent of the 2011 filing season, it was not known whether Oregon would adopt the federal extensions or disallow them, and I already explained that to you. SB 301, that was Senate Bill 301, was passed during the 2011 filing season, and the bill provided for a reconnect of Oregon to federal law for some provisions and a continued disconnect for other provisions. The following table summarizes some of the more important items that do and do not conform to federal law. And the first one we're looking at here is the educator expense. Federal treatment allows a maximum $250 deduction to be claimed as an adjustment to income. Oregon did reconnect to this provision and also allows the deduction. So if you claim the deduction on your federal return, you will automatically be claiming that same deduction on your Oregon return, and no adjustment is required. For the tuition and fees deduction, the maximum $4,000 deduction is claimed as an adjustment to income on the federal return. Oregon does allow this adjustment, but it does not require an adjustment on the Oregon return because the Oregon return pulls from the federal adjusted gross income. So if you claimed this deduction on the federal return, you will make no adjustment on the Oregon return because it's already being claimed on Oregon. Now, there had been a possibility at the beginning of the 2011 filing season that Oregon was not going to connect to this provision, and if it had not connected, we would have had an addition in 2010 and 2011. However, Oregon did connect, so no adjustment is made to the return. Bonus depreciation. Special 50%, 75%, and 100% bonus depreciation allowances are allowed on the federal tax return for tax years 2009 through 2012. Well, Oregon did not allow bonus depreciation for 2009 or 2010, but it does allow it for 2011 and 2012. So I have an illustration coming up to show you how that works. Section 179 deduction. Federal law increases the maximum amount of the deduction to $500,000, but Oregon allowed a maximum deduction of only $134,000 for tax years 2009 and 2010, but it is also allowing a deduction of up to $500,000 for 11 and 12. Qualified leasehold improvements. Federal law allows certain leasehold and restaurant improvements to be depreciated over 15 years rather than 39 years. Qualifying property is also eligible for bonus depreciation and the Section 179 deduction. Oregon law specifically did not conform to federal law for tax years 2009 and 2010, which means if you claimed bonus depreciation on your 2009 or 2010 return, you would have had a federal deduction claimed that was larger than the amount of deduction that Oregon allows you to claim. And as a result of that, you would have had an Oregon addition in the year that you claimed bonus depreciation on the federal return. And for all years after that year, that first year being placed in service, which is 9 or 10, you're going to have an Oregon subtraction. And that can be a little bit difficult to understand, so I have an illustration coming up that will show how that computes out. So moving on with Oregon additions, depreciation differences, we've touched on them already. If you claimed bonus depreciation or excess Section 179 expense deductions in 2009 or 10, you would have reported an Oregon addition in the earlier year. Oregon has reconnected to federal law for 2011, therefore you do not need to report additions for differences between federal and Oregon depreciation for assets placed in service in 2011. Imputed income for health care coverage provided to certain adult children. Prior to 2010, federal law allowed a payroll exclusion for the cost of employer-paid health insurance premiums paid for an employee and the employee's spouse, dependent children under the age of 19, and children aged 19 through 23 who were full-time students. For 2010 and future years, federal law is expanded to allow an income exclusion for employer health insurance coverage for adult children who are aged 19 to 26, even where the adult children are not dependents. And this was part of the Obama Health Care Act that was passed in 2010. In 2010, however, Oregon did not adopt the new federal law that allowed health insurance premiums paid for adult children 19 through 26 to be excluded from income. Thus, for 2010 returns, health insurance benefits excluded from federal income that were paid for adult children who were not students under the age of 24 were an addition to Oregon income. But for 2011 and future years, Oregon has reconnected to the federal law, and there is no need to add back the fair market value of the cost of health insurance. Also, we have the domestic production activities deduction. Now, this is not new, but what I find is a lot of different tax software packages out there do not incorporate this particular law, and so it is a frequent reason for adjustment on the Oregon return. By that, I mean that the Oregon return is filed with the Department of Revenue, and the Department of Revenue adjusts the tax return because it claimed a deduction it should not have, and it claims a deduction by not creating an addition on the Oregon return for any domestic production activity deduction claimed. So I don't have a picture of the federal Form 1040 in front of me, but one of the adjustments to income that you can claim on the front page of the federal Form 1040 is a deduction for the domestic production activities deduction. It is claimed as an adjustment to income. If you claim that adjustment to income on the federal return, it automatically carries to line 8 of Oregon Form 40. But Oregon does not allow that deduction, and so anytime you have that deduction claimed on the federal return, whatever that deduction is, you must enter an addition on the Oregon return. And what I see is that tax preparers do not enter those additions, and so when the tax return gets to Oregon, Oregon sends a letter to the tax client telling them the return was prepared incorrectly. So it's just a caution to Oregon tax preparers out there to be on top of it. You identify the addition on Form 40, line 11, and identify the addition by entering code 102 on the line. Next up is Oregon subtractions. The federal tax subtraction limit has increased by $100 to $5,950 for all filing statuses. Prior to 2010, however, married filing separate was allowed 1/2 of the normal subtraction. And interestingly, one of the most frequently missed Oregon Tax Board exam questions was a question involving the federal tax subtraction, where the examining student was supposed to notice that the filing status was married filing separate, and therefore the filer was going to be allowed only 1/2 of the federal tax subtraction. Well, that most frequently missed question can be thrown out now because it's no longer the case that the federal tax subtraction is 1/2 for married filing separate that it is for joint, because now whether you file separately or jointly, you are allowed the full subtraction. And again, that is $5,950. Every filing status is allowed the subtraction unless a taxpayer falls under the new income limits, which provide for a phase-out of the deduction. Married filing separate and single filers begin the subtraction phase-out at $125,000 of AGI, and all other filing statuses begin their phase-out at $250,000 of AGI. If your income is higher than these amounts, refer to the federal tax subtraction tables and worksheets to calculate your allowable deduction. And here is the table. And what you will see is it shows that you are allowed a maximum federal tax subtraction of $5,950 if your income is between $0 and $125,000. And you'll see it's talking about the federal adjusted gross income. It's not talking about taxable income. And then once your income hits $125,000, you've got a $5,000 spread here between $125,000 and $130,000. And in that $5,000 spread, you've essentially lost $1,000 of your subtraction. Actually $1,200 of your subtraction, and you keep losing $1,200 at a time until your income hits $145,000 or more, and when it does, you get no subtraction at all. You can take all of these phase-outs and simply double them to get the phase-out range for married filing joint and qualifying widow, and also head of household. Here is the federal tax subtraction worksheet, and you use this worksheet to figure your subtraction before you factor in any kind of phase-out. It's important to note that the Oregon federal tax subtraction is computed. It's not an automatic thing that you look to a particular line of the tax return and pull that number. But as a general rule, you could look at line 61 of the federal Form 1040 where your total tax is listed, and more often than not, it could be the case that that is your federal tax subtraction for Oregon. However, you don't stop there, and the reason you don't is that there are certain taxes included on line 61 that Oregon does not allow you to subtract, and there are other taxes included on line 61 that Oregon does allow you to subtract. So the instructions for calculating the Oregon federal tax subtraction do not tell you to look at line 61. Rather, and instead, they tell you to look at the amount of tax shown on line 55, And then they allow you to add in the tax on qualified retirement plans that are shown on line 58 of the federal Form 1040, and they allow you to enter any recapture taxes that you included on the dotted line of Form 1040, line 60. And you add those numbers up and enter that total on line 3. Then you need to subtract out any American Opportunity Credit that you claimed, but only the refundable portion of that credit that is shown on Form 1040, line 66. You then subtract out any first-time homebuyer credit that is entered on line 67 of your 2011 return, and you total all of those numbers up. When you get your total, you look to see what is the smaller number, the total tax you've paid or $5,950, and you claim the smaller of those two numbers as your federal tax subtraction. So just as a reminder here, the credit for a home purchased in 2008, that was the first-time homebuyer credit for individuals who purchased a house in 2008, that credit had a maximum credit amount of $7,500. And because that $7,500 was deemed to be a loan, it was not considered by Oregon to be a reduction of federal tax. And so Oregon's attitude towards that 2008 credit is that you did not reduce your federal tax subtraction in the year that you claimed that credit, but you also do not increase your federal tax subtraction when you pay the credit back. So remember, beginning in 2010 and future years, if you claimed that 2008 credit, you're going to be entering a repayment of $500 each year on your Oregon or on your federal Form 1040, line 59. Well, whatever amount you enter on line 59 does not add to or increase your federal tax subtraction for Oregon. Now, the credit that was claimed for homes purchased in 2009, 2010, and possibly for some individuals in 2011 as well, has a maximum amount of $8,000, and this amount is not required to be repaid in most cases. It is therefore considered to be a reduction in your federal tax liability. And if you claim the credit on your 2011 return, you must subtract the credit amount claimed from your federal tax liability, but not below zero. So let's just suppose on your Oregon return, you're showing that you have a federal tax liability of $6,000, but you're also showing you claimed a federal tax credit for a first-time homebuyer of $8,000. Well, the credit is more than your tax, so on Oregon, you'll claim a federal tax subtraction of zero. The Making Work Pay credit was a credit allowed in 2009 and 2010, and it did reduce federal tax and therefore did reduce the federal tax subtraction for Oregon, but it is gone in 2011, so no adjustment will be made on 2011 tax returns. American Opportunity Credit, the refundable portion, as I showed you on the worksheet, this particular credit does reduce your federal tax liability for purposes of calculating the federal tax subtraction. So I just wanted to show you how this federal tax subtraction calculation goes, and with an illustration that I created for you. Jackie was a half-time student enrolled in a degree program. She earned $25,000 of wage income and paid $8,000 in qualified education expenses. Jackie's federal tax return shows a federal tax liability on Form 1040, line 61 of $404. She received a refundable American Opportunity Credit in the amount of $1,000. Well, right there you're going to see her credit is more than her tax, so her subtraction is going to be zero. So we're going to report a federal tax subtraction of $0 on Form 1040, line 13. Jackie can claim a $4,000 tuition and fees deduction on Form 1040, line 18. So let's take a look at her federal Form 1040. I've just got page 2 inserted in the manual because we're going to start with her adjusted gross income on line 38 at $25,000. And we go through and figure her standard deduction, her personal exemption, and we get her taxable income showing on line 43. The federal tax tables give us tax of $1,904. But we're going to go over and look at the non-refundable portion of her education credit. That non-refundable portion is $1,500, and it reduces her federal tax down to just $404. So you can see that we've entered $404 on line 61. She had on line 62 $1,500 of federal tax withheld on her W-2. And then on line 66, we show that refundable portion of the American Opportunity Credit And so here's where we're going to see the math. 404 minus 1,000 gives us 0 federal tax for Oregon. And you can see here that the federal withholdings end up being more than the amount of withholding she actually had, which is $1,500. So her total payments, $2,500, exceed her tax of $404, and she gets a $2,000 refund. Her refund is more than she paid in. We have the same situation when we claim the earned income credit, but Oregon does not require you to reduce the federal tax subtraction by any earned income credit you received. It only requires you to reduce the federal tax subtraction for American Opportunity Credit and the first-time homebuyer credit. Okay, so we're moving on now to Jackie's Oregon return, and I just wanted you to see how these computations carried over to Oregon. The first line on the Oregon return is the adjusted gross income from the federal return, and in Jackie's case, that was $25,000. And you can see on line 13, that is the line where we enter the federal tax liability, but for poor old Jackie, that happens to be 0. However, Jackie is going to benefit from another kind of deduction on her Oregon return. Because Jackie claimed the American Opportunity Credit on her federal return, she is eligible to claim a tax subtraction on her Oregon return. Her subtraction is equal to the tuition and fees deduction she could have claimed but did not claim on her federal return because she claimed the American Opportunity Credit instead. And that subtraction has a maximum amount of $4,000, and that is the subtraction that Jackie is allowed to claim. She enters that on line 18 with a code of 308. That $4,000 subtraction is entered on line 19, and she ends up with Oregon income after subtractions of $21,000. Her next step is to enter her standard deduction of $1,980, and that gives her Oregon taxable income of $19,020 and Oregon tax before credits of $1,498. Moving on, other subtractions related to the federal tax subtraction. Federal tax paid in a prior year. You can claim a subtraction for federal tax paid for a prior year if you paid additional federal tax in 2011 on a prior year amended federal return. Now, one of the most common mistakes that the Department of Revenue sees, it has this list of top 10 mistakes. One of the top 10 mistakes preparers make is that they amend the Oregon return for the same year that they amended the federal return. And on the Oregon amended return, they make an adjustment upwards or downwards for any change in federal tax on the federal return. But Oregon doesn't want you to do that. If you filed your 2009 federal return 2 years ago, it's gone. Whatever tax you calculated on there, whatever federal tax subtraction you claimed on Oregon is history. But if in 2011 you amended that 2009 federal return, and that 2009 federal return shows a reduction in federal tax, to the extent you have a reduction that causes a change in your federal tax subtraction for Oregon, Oregon wants you to add that back in to income as an addition in the year you get that refund, which would be 2011. Let's look at it another way. Let's suppose in 2009 you filed your federal tax return and it showed a liability of $1,000. So on your Oregon return for 2009, you claimed a federal tax subtraction of $1,000. Well, in 2011, you amend your federal return and increase the amount of federal tax from $1,000 to $3,000. Well, now Oregon is going to say, don't go back to 2009, amend 2009, and increase that federal tax subtraction to $4,000. Please don't do that. What we want you to do is on your 2011 return, claim a federal tax subtraction for the tax you paid for that earlier year. But do not claim any more tax than the maximum subtraction allowed for 2011. So if the difference that you paid out in 2011 for that earlier year is $3,000, but for Oregon for 2011 you also have a $4,000 federal tax liability, then your deduction would not total $7,000. It's not going to total $4,000 for 2011 plus the $3,000 that you paid for the earlier year. It's going to, which would be $7,000, because $7,000 is more than $5,950. But you would be allowed to claim $5,950 even though your federal tax for 2011 is only $4,000 because you paid that additional amount for the earlier year. So that is one of the most common mistakes Oregon tax preparers make on tax returns. And having just finished explaining it to you as simply as I could, it's a pretty complicated thing to explain. So it's understandable to me why people are confused by it. And I have to admit, when I was a young and inexperienced tax preparer, I made that mistake myself, and I did it more than once, of course, in the past. The foreign tax subtraction. Well, the foreign tax subtraction works a little bit like federal tax paid in a prior year. But of course, with the foreign tax subtraction, we're looking at foreign taxes that were paid in 2011, and we're not concerned with any kind of prior year amendments. So what happens is that for Oregon, you are allowed to claim a federal tax subtraction of up to $5,950 for the year. But you are also allowed to claim a foreign taxes paid subtraction of up to $3,000 per year. But the combined total of your foreign tax and your federal tax cannot exceed $5,950. So let's just go back up and look at this Oregon form right here. Let's just suppose that your federal tax liability for the year is $4,000 and that you also paid $3,000 of foreign taxes. Well, the amount of subtraction that you would be allowed to enter on line 18 would be the difference between the $4,000 on line 13 and the maximum allowable subtraction of $5,950. So essentially, you'd enter $4,000 on line 13, and you would be allowed to enter $1,950 on line 18, and you would, of course, enter the appropriate code for payment of foreign taxes. Next up is the Oregon College Savings Network. You can claim a subtraction on your Oregon return for contributions you made to the Oregon 529 College Savings Network to that account during the year. You can also claim a subtraction on your 2011 Oregon return for carry forward amounts from earlier years. And I'll explain that more in just a second. These state-sponsored plans qualify for special tax status as qualified tuition programs under Internal Revenue Code Section 529. The deduction for 2011 is $4,240 if your filing status is married filing joint. That is an increase of $60 over the maximum deduction allowed in 2010. The deduction for 2011 is limited to a maximum of $2,120 for all other filing statuses, and that is a $30 increase over 2010. If your contribution amount is more than the maximum deduction allowed for your filing status, you can carry forward the remaining balance for up to 4 years. So let's just suppose in 2011 you put $10,000 into your child's 529 plan. Well, if you're filing a joint return, you would be allowed a $4,240 deduction on your Oregon return. You would claim that deduction as a subtraction to income on line 18 of Form 40. You would then carry forward the remaining amount of the subtraction. $10,000 minus $4,240 carries forward to 2012. And in 2012, you would be able to claim another $4,240 as a subtraction on your 2012 return. And if the subtraction increases for 2012, you'd probably be able to claim a little bit more than $4,240 in 2012. But in 2012, you would still have a little bit of carry forward left, and that would go into 2013. Now, another way to look at it would be, okay, in 2010, my client put in $10,000 into their child's 529 plan, and in 2010, they claimed a subtraction on their Oregon return. But the subtraction was less than the contribution, so they're going to have a carry forward to 2011. So what that means is you should be asking your clients as a tax preparer if they have a 529 plan. And if they say, yes, I did, but I didn't put anything in this year, then what you need to be asking them is, okay, when you put money in last year, was the amount you put in more than the amount of subtraction allowed? Or do you have a carry forward from an earlier year that we can now put on the Oregon return for 2011? Now, you do have until the due date of your return, not including extensions, to contribute to an Oregon College Savings Plan and claim a deduction on your return. For 2011 returns, this deadline is April 17, 2012. So if during the process of interviewing your client, you say to your client, now, have you made any contributions to your child's Section 529 plan? Your client might say, no, but I was thinking about doing that. Do I get a tax deduction if I do that? And the answer is, well, yes, you do. And if you make the contribution before April 17th or by April 17th, you'll be able to claim it on your 2011 return, even though you didn't make it until 2012. Now, again, as I already said, if your contribution is greater than your allowable deduction for the year, carry forward the amount not subtracted over the next 4 years. Beginning with the 2012 tax return, so this is a change for 2012 and future years, taxpayers will be able to direct deposit some or all of the refund with a minimum of $2,500 or $25 into an Oregon College savings account. The taxpayer must already have the account set up, and the election to contribute may not be changed or revoked after the return has been filed. So what this is saying is that in 2012, and actually in 2013, when we're preparing 2012 returns, if you see your client has a refund coming from Oregon, they could make an election with their Oregon tax return to directly deposit their Oregon refund into that 529 plan, and that would actually fund the plan from the refund, and they could take a deduction for the amount that they're about to deposit. So that's kind of neat. Federal depreciation disconnect. So I promised you earlier when we were talking about the differences between federal and Oregon depreciation that I would talk to you about it a little bit more, and this is where we're going to do that. Bonus depreciation for purchases made or assets placed into service between January 1, 2009 and December 31, 2010 were not allowed for Oregon. Use the Oregon depreciation schedule, and the form number is 150-101-025, to determine your addition or subtraction for Oregon purposes. And here is an example. I believe this comes right out of Pub 17.5. And in this example, you have a 7-year asset that had a cost of $100,000. On the federal return for the year it was placed in service, which was 2010, you claimed 50% bonus depreciation and depreciated the asset using the half-year convention and 150% declining balance. Oregon is depreciating the asset using the half-year convention and 150% declining balance as well, but it doesn't allow for any bonus in 2010. So in 2010, the federal depreciation deduction would have been $55,355, but the Oregon depreciation allowed is only $10,710. So on that 2010 Oregon return, there would have been an addition of $44,645. But for 2011 and all future years, the Oregon depreciation is more than the federal because the balance left to depreciate is higher. So for each of the other years, we actually have an Oregon subtraction. After 7 years of depreciable use on that property, the total depreciation claimed on both federal and Oregon is the same. It's just that the federal allowed more early on, and Oregon is allowing more over time, until in the end the totals are the same. So how do you figure the Oregon difference in depreciation? Well, you complete Oregon depreciation schedule 150-101-025, and you complete that schedule each and every year to compute the differences between Oregon and federal depreciation. Oregon does not want you to file the form with your Oregon return. They want you to keep it with your records. And here is an illustration. On 4/1 of 2010, Clayton purchased a new production line for his business at a cost of $100,000. The asset has a recovery period of 7 years, and Clayton did not elect out of federal bonus depreciation. He also did leasehold improvements to his building costing $50,000. For 2010, on his federal return, Clayton elected to claim 50% bonus depreciation on both assets. He used 7-year 200% declining balance under the half-year convention for the production line and 15-year 150% declining balance for the leasehold improvements. Calculate Clayton's first-year federal depreciation as follows. Well, we go with the production line first. It has a cost basis of $100,000, bonus depreciation of $50,000. We're depreciating it at a rate of 200% declining balance and the half-year convention. So that gives us $7,145 on the remaining $50,000 balance. We add $7,145 to $50, and we get federal depreciation for 2010 of $57,145 on that production line. We move over to the leasehold improvements, and this is a really even a bigger difference. Because at the federal level for 2009 and 2010, you're allowed to treat leasehold improvements as 15-year property rather than as 39-year property. But Oregon did not follow that law for 9 or 10, which means for the federal, we have a cost basis of 50 with a bonus depreciation deduction of 25,000 and 150% declining balance and a half-year convention on the remaining $25,000 balance. So 25,000 divided by 15 years multiplied up by 150% declining balance times the half-year convention gives us an additional depreciation deduction on those leasehold improvements on the federal return for 2010 of $1,250. So we take $1,250, add that to 25,000, and we get $26,250. So $26,250 is the total federal depreciation allowed on the leasehold improvements, and $57,145 is the total depreciation allowed on the production line. We add both of those numbers together, and we get $83,395 of federal depreciation in 2010. Now, on those leasehold improvements, Oregon does not allow bonus depreciation at all. And in addition, it doesn't allow 15-year life. It only allows 39-year life. So when all is said and done, you get only $802 as an Oregon deduction for the leasehold improvements. And we get $14,290 of depreciation on the production line. So in the end, you take $14,290 plus $802, and you get total allowable Oregon depreciation for the year of $15,092. So in 2010, federal depreciation was $83,395. Oregon was only $15,092, and that leaves us with an Oregon addition on the 2010 Oregon return of $68,303. Well, we carry forward to 2011, and now things are different. In 2011, we're going to see depreciation for these assets is going to be lower on the federal than it is for Oregon. So for 2011, we're going to have an Oregon subtraction. So we complete Oregon's 2010 Oregon depreciation schedule as shown below. And you can see that we have the production line listed. We have the leasehold property improvements listed. We show the rate of depreciation. We show the cost. We show the method of depreciation. We show the Oregon deduction, the federal deduction, the Oregon deduction, the federal deduction. And when we're all said and done, we end up with Oregon depreciation of $15,092. It matches this number right here. And we have federal depreciation of $83,395. That matches this number right here. And then we have the difference, $68,303. That matches this amount here, $68,303. And the Oregon instructions say that you have an Oregon addition and that you should have entered this as an Oregon addition on your Oregon return. For 2011, we're just going to continue on with our story. Clayton's still running his business. And in 2011, Clayton made the following investment in equipment for his business. He purchased a computer system costing $10,000. Under 2011 federal depreciation rules, Clayton will depreciate this asset as follows. He will claim 100% bonus depreciation on his computer system. Well, for 2011, Oregon has now reconnected with federal law, including for bonus depreciation. So Oregon will allow the same deduction on the 2011 asset that the federal does. So no adjustment is required for this particular asset. That is the computer system placed in service in 2011. Both Oregon and federal allow the same deduction. But we still have an adjustment to deal with on 2011 because of the assets placed in service in the earlier year, 2010. And as I showed you up here, we have a depreciation difference for Oregon of $11,152, and we're going to use the 2011 depreciation schedule to show those differences. So here we have the Oregon deduction allowed for 2011 on the production line. We have the leasehold improvement deduction allowed on the Oregon return. On the federal return, we'll see that the depreciation on the production line is less than it is for Oregon, but we'll see that the leasehold improvements is higher than it is for Oregon. But in the end, the total depreciation deduction allowed on the federal is less than it is for Oregon. The difference between column G and column H is $11,152, and because column G is the bigger number, we carry the entry onto line 3, and we now have an Oregon subtraction. And this Oregon subtraction will be entered in line 18 of the Form 40. Some other subtractions of note This is not a new rule for 2011, but it was new in 2010, so we're just re-mentioning it. Beginning with tax year 2010, Oregon allows a subtraction for severance pay that is invested in a qualified Oregon small business. Severance pay that you receive during the year and invest in a new or existing small business is eligible for the subtraction. To qualify, you must materially participate in the operation of the business. The business must be formed as a legal entity with the purpose of making a profit. It must be independently owned from all other businesses and have 50 or fewer employees. Your investment in the business must continue for at least 24 months after termination from your employment. The subtraction is limited to the lesser of your minimum investment, or $500,000. You must claim the subtraction in the year the severance pay is received. If the pay is received late in the year, the individual has until the due date of the return, including extensions, to make the investment. For more information and examples of when the severance pay subtraction is and is not allowed, go to this URL link that we've inserted in the manual. Oregon tax rate charts. As a result of the passage of Measure 66 in 2010, Oregon now has 2 additional tax rates that affect higher income individuals. Before 2010, the highest tax rate any Oregonian paid was 9%. And so Oregon at that time had a 5% bracket, a 7% bracket, and a 9% bracket. But as a result of that legislation, the highest brackets were increased, and they were increased retroactively back to 2009. So for 2009 forward, we now have new 10.8 and 11% brackets, but they are intended to affect only higher income individuals. I wouldn't call them rich, but certainly higher income. You move into those higher brackets when your income exceeds $125,000 if you are single or married filing separate, or if your income exceeds $250,000 if you are married filing joint, head of household, or qualifying widow. And you can see here that we have the tax rate charts for 2011. And if your income is over $50,000 but not more than $125,000, that is your Oregon taxable income, then you are in the 9% bracket. And of course, your Oregon taxable income is your Oregon income after you claim your Oregon itemized deductions and your Oregon standard deduction, or your Oregon standard deduction. So your taxable income is typically less than your adjusted gross income, although not always. And then when we move over to Chart J, we can see that if your income is over 50 but not over 250,000, you are in the 9% bracket. But when your taxable income is over 250 and less than $500,000, you move into the 10.8% bracket. And if your taxable income is more than $500,000, then you move into the 11% bracket. Oregon credits. Oregon's exemption credit, as I explained at the start of class, is up from $177 to $179. Oregon's exemption credit never goes up by that much. You know, $2 a year is usually what we get. If you've been at it long enough, you'll remember, 20 years ago when maybe it was only $89. So it does, over time, actually go up more significantly. But year to year, it's just the tiniest change. Now, there is an Oregon exemption credit worksheet. You are subject to a phase-out. What that means is if your income is above a threshold amount, you may not be allowed to claim $179. You may only be allowed to claim a lesser amount or no credit at all. So here is the table that you can look to see whether you're going to be subjected to a phase-out. If your income is less than, or pardon me, your federal adjusted gross income is less than or equal to the amount shown here for your filing status, you are allowed the full $179 credit amount. But if your income is greater than $169,550, but less than or equal to $252,050, you're going to get a partial credit. And if your income exceeds $252,050, then you are going to get no credit at all. Of course, these numbers double for married filing joint. They're less if you are married filing separate. And if you're head of household, they're a little bit more than single but less than joint. House Bill 3672 was passed during the year, and it amends energy credits for Oregon. It allows for amendments and some sunsets and creates a number of tax credit programs within the Department of Energy. The bill is effective on the 91st day following adjournment of the legislative session, and most changes take effect at that time, although some were retroactive. Changes to the residential energy tax credit and the biomass producer and collector tax credit are effective beginning January 1, 2012. There's some significant changes to this program. that really are going to affect a large number of taxpayers. Oregon's had a series of energy credits that have really been a boon to individuals for many, many years. But I think just in the current budget crisis, Oregon was looking for where they could raise some revenue, and they decided to raise revenue by taking away these credits. And so there's a significant number of credits that are just disappearing. So for 2012 and later years, the state of Oregon will no longer allow tax credits for energy efficient appliances and alternative fuel vehicles and vehicle conversion equipment. Credits are allowed for qualifying vehicles and appliances that were purchased in 2011. So what that means is that 2011 is the final year for claiming these energy credits for purchase of a plug-in electric vehicle, and examples of plug-in electric vehicles include the Nissan Leaf and Chevy Volt. I know for sure there's more than one Nissan Leaf that was sold in the state of Oregon in 2011, so someone will be claiming credit there. I don't know of any Chevy Volts here yet. Qualifying refrigerators, dishwashers, and washing machines. This is the final year for claiming a credit for purchasing one of those. And qualifying air conditioners and boilers. 2011 is the final year on those. But items that qualify for energy credits for 2011 and continue to qualify for credits in 2012 and later years include renewable resources, including wind, solar, and geothermal systems, high-efficiency furnaces, high-efficiency on-demand or tankless water heaters, duct sealing, premium efficiency wood and pellet stoves, heat pumps, ductless mini split heat pumps, heat energy recovery systems, and alternative fuel vehicle infrastructure. Sarah says she saw a Chevy Volt, so we know at least one's been sold in Oregon. Hot dogs. I'd love to see one. Business energy tax credit sunsets. Business energy tax credits typically are not something that affect filers at the individual level. However, business energy tax credits, when they are claimed, might be claimed on a partnership return, or they might be claimed on an S corporation return. And if they were, they will flow through to the shareholders on their respective K-1s. So it's entirely possible that you're going to have a client who is an individual who has received a K-1 showing that they're entitled to some Oregon energy credits. And there are a variety of energy credit systems out there that can be claimed. But most of them, virtually all of them, require a complex application process that is done with the Oregon Department of Energy by the business at the time or even prior to the time that the project begins. So it's a complex process. At the tax preparer level, we're not really dealing with this at all. Our clients will be coming into us with paperwork confirming entitlement to a credit, and if they are entitled to the credit, we'll claim it on the return. Energy conservation projects, this is a new rule. This program allows tax credits for any capital investment for which the first year energy savings yields a simple payback period greater than 3 years with listed exceptions. It's again, it's directed at businesses, and businesses go through an application process. It costs them money to apply. They have to go through certification and so forth. So again, at the tax preparer level, we don't see it, except for when they are approved and they're given a certificate for the credit, and then we claim that on the return. Other expiring tax credits are listed here. 2011 is the final year to claim these credits, including water transit vessels, crop donation, diesel truck engines, energy conservation lenders, and biofuel consumers, as well as biodiesel used in home lending, reforestation, riparian lands, and workers' compensation insurance. And for more information about any of those credits, you can visit the Oregon Department of Energy website. Another significant change that did come into play during the 2011 legislature was how the Oregon kicker is going to be issued. In the past, the Oregon kicker was issued as a check in the mail, and that will no longer be the case. So for the 2011 through 2013 biennium, the legislature will meet near the end of the near the end of that cycle, and at the end of that cycle, if they determine that the revenues pulled in are 2% or more, or greater than 2% of the amount that they thought that they would bring in, a kicker can be generated. But that kicker will no longer come in the form of a check. It will be allowed as a refundable credit on the tax return for the year. So we have an example here. Sally has a 2012 state tax liability of $4,000 before credit. And the Oregon legislature meets at the end of 2012 and determines that there is going to be a kicker allowed, and that kicker is going to be 10% of the tax shown on her return. She would receive a refundable credit of $400 that she would enter as a payment amount on her 2012 return. And she would get it with her Oregon refund for that year if she had a refund, or it would reduce her Oregon tax owed if she was in a state where she was owing. Other Oregon return items, you can now donate part of your Oregon refund to the Oregon Cascades Project. And just as a reminder, Oregon now has a checkbox that allows you to contribute $3 of your Oregon refund to an Oregon political party. Now on the federal return, when you check the box, it has no impact on your federal refund. Giving $3 away to the federal presidential campaign fund does not affect your federal refund. But if you check the box on your Oregon return to give $3 to the political party, you actually are losing $3, and you're giving up $3 of your refund to do that. These are all of the different Oregon political parties that you can donate $3 to. Marginal corporate tax rate and the minimum tax rates. Beginning in 2009, the minimum corporate tax rate has gone up. It's $150 for S corporations and partnerships doing business in Oregon. And for C corporations, the tax is based upon the amount of revenue or taxable income that the business has. So if the business has taxable income of $250,000 or less, the tax rate is 6.6%, but the tax owed can never be less than $150. And we look at your tax rate, and we also look at your gross revenue tax, and these are the tax rates based on revenue, and these are the tax rates based on profit. And you're going to pay the higher of those two amounts. And here is a list of the top 10 preparer mistakes that Oregon says Oregon tax preparers make on their return, including the one I spent some time talking about. The amount claimed on the return, actually it'll come in a minute, but the amount claimed on the return does not match the amount in the taxpayer's estimated tax account. What that means is the taxpayer said they paid $1,000 of estimated tax to Oregon, but Oregon didn't get $1,000 of estimated tax. It got something higher or lower, and that's a very common mistake. The amended return shows an increase or decrease in federal tax that should be reported in the year the tax is paid or the refund is issued, and not in the year that the tax is attributable to. So that was what I was talking to you about earlier. The Oregon tax deduction is less than the withholding for the current year. So you're claiming credit for money you never paid in. Direct deposit account information. The Oregon Department of Revenue cannot change the numbers entered on the return. So if you file a tax return either paper or electronically with the wrong account information on it, well, Oregon can't change that. You're going to have to wait for the money to go to the bank. The bank will need to reject it. The bank will need to send it back to Oregon. And when that happens, Oregon will issue you a paper check. Tuition and fees subtraction claimed when no federal credit is claimed. Again, the tuition and fees deduction on Oregon is only allowed where you chose to claim a credit on the federal return rather than tuition and fees deduction. And then the credit is, or the subtraction is the lesser of the tuition and fees paid or $4,000, or the difference between $4,000 and maybe another tuition and fees deduction amount claimed for another student. Child and dependent care credit. The Oregon Child Care Credit is computed different than what is claimed on the form, so the tax form is essentially done incorrectly, or maybe it was done correctly, but it was carried incorrectly to the Oregon return. An incorrect code is used for an other addition, subtraction, or credit. The Oregon Department of Revenue sees many subtraction codes used on the credit line. Probably vice versa as well. Oregon Earned Income Credit computed is different than what the practitioner claimed. Either the federal EIC was computed incorrectly, which changes the Oregon credit, or the Oregon credit was computed incorrectly. And remember, your Oregon credit is 5% of your federal credit. If you are filing an Oregon-only Schedule A, include the Oregon income tax you paid on line 5 of the Schedule A, and then subtract that amount out as a state income tax claimed as an itemized deduction on the Oregon return. So Oregon, when you file Schedule A for Oregon only, they don't want you to leave the Oregon tax off. They want you to put the Oregon tax on, claim it as an itemized deduction, and then add it back into income again on another line. Oregon Department of Revenue Tax Practitioner Liaison meetings. There are 4 meetings a year. They used to be held monthly, but now they are only held 4 times a year. And the meetings for 2012 are going to be on April 27th, July 27th, October 26th, and December 7th. And if you attend those liaison meetings, you get updates on what's happening in Oregon Department of Revenue, including how they're processing returns and law changes. Another reminder here on property tax forms. If you own a business, you are required to file a personal property tax report each and every year with most counties. That is the county that you do your business in. And that report has a very weird due date, March 1st, 2012. And the thing is that most filers, when they come in to do their tax returns, business owners, when they come in to do their tax returns, they bring that property tax report in with them. And the property tax report, by the time we see it as tax preparers, is already late because the due date is March 1st, and we're typically not filing their tax returns until March 15, April 15, or if they're on extension, well into the summer and into the fall. So these reports are frequently late, and the counties do charge late filing penalties and late payment penalties. So it's important to notify your clients that if this report, if they're required to file this report, and they always are required to file it, that it's due March 1st, and they need to get that out right away. Oregon has a new website feature that will allow you to do more income tax transactions online, including a how much do I owe feature. And they'll allow you to go in there, see how much you owe, and make payments. And this is what it looks like on the page. You have some various steps here. You have to go and create an account number for yourself, or create an account for yourself in the online system. But once you've done that, you can make online payments. And I have a number of clients who probably love that feature. Practitioner assistance. Oregon has discontinued the tax practitioner phone line. So you should use the resources available on the Oregon Department of Revenue website to answer your questions. And if you can't find the answer to your question, you need to call the same phone number as all other taxpayers out there, and that's this phone number. Now, when Oregon did have a tax practitioner phone line, I personally found it quite worthless because all you could do is leave a message, and then whoever answered that message would call back when I was with a client, and I never could contact them. So I tried using it once or twice and gave up. But they do have email addresses that you can use, and these are the email addresses where you can email your questions. There is also a court fee increase. If you need to take your case to Oregon Tax Court, the fee has increased from $75 to $240. Oregon had an amnesty program operating in earlier year. The amnesty program ran between October 1, 2009 and October 19, 2009, and it affected tax returns for before 2008. The amnesty program allowed people to come forward, apply for amnesty, and then it gave them until January 19, 2010 to file all of the back year returns. All taxes owed with those returns were due by May 31st, 2011. Oregon Department of Revenue allows an extension of the deadline for good cause. That is an extension of the deadline for payment due to good cause, but it provides no guidance on what good cause might be. Isn't that nice of them? The final little bit of our manual, I know we're just a couple minutes over time here, but I'll point out the final things that I like to point out each year, because as practitioners in Oregon, we are governed by the Oregon Board of Tax Practitioners, and I do like to point out those areas of tax law that are most important, I think, ethically to how we operate our businesses. And there's been some significant changes that the Oregon Board has made to the definition of advertising and solicitation. And the words that you see here in bold are inserted and intended to replace other words. So it says here, for example, as used in this rule, advertise and advertising means any form of printed, broadcast, or electronic material that makes known professional tax services. They've replaced that with the wording professional income tax services. This includes but is not limited to business cards and business stationery, and they've inserted all web and e-commerce advertising of an individual or tax business, and they've replaced that tax business with tax preparation business. And it goes on to talk about no false advertising. Then down at the bottom, it adds, there's something else I'm going to point out that is important. No licensee shall advertise to give a discount unless the discount is based upon a basic fee schedule posted in public view in the licensee's place of business, and the fees on the posted basic fee schedule are the usual and customary charges of the tax preparation business, and the basic fee schedule must include the minimum fees charged for at least one of the following forms and schedules, including 1040, 1040A, 1040EZ, Schedule A, B, Schedule EIC, Form 2441, Form 8812, and Oregon Form 40. Now, clearly, there are a lot more forms than that, and obviously, it would just be good customer service and good disclosure to list all of the fees that you charge to your customers so they can see what those are. But the Oregon the Oregon Board of Practitioners requires you at a minimum disclose these fees in a public place. Also, new rules that are in bold here, they don't take effect until July of 2012. So if you've got stationery printed, or if you've got business cards currently printed, or if you have advertisements currently printed that do not contain this information, you don't need to panic because you're not out of compliance yet. But it would be a good idea that if you are placing new print orders right now, that you begin immediately including this information. The information that must be included is that all business advertising must include the board-issued business registration number of the firm or the license number of the firm's designated licensed tax consultant. And all individual advertising must include the licensee's issued license number. So in other words, if you see an ad in the phone book, that phone book ad should contain the business number or the licensed tax consultant's number. And if you're looking at a business card that a licensed tax practitioner might hand out, that business card should contain their license number. So that would be a good example of the two. On the continuing education side of things, Oregon previously required that every single correspondence course be individually approved. And if the course was not an approved course, then Oregon tax licensees could not get credit for it. They have changed that rule to say that if that course or that education provider is already approved through CTEC or NASBA or the IRS, then you can automatically know it's approved for Oregon. But if the correspondence course or online course is not approved by one of these approved organizations, then it must be separately approved by the board. So you should be looking for and obtaining your continuing education online and correspondence only from providers who are approved by one of these independent accrediting agencies, or that you can see on the Oregon Board of Tax Practitioners website that that course has been independently approved by the board itself. Also, the board is pointing out that they have clarified that a continuing education hour must have at least 50 minutes of instruction in it. Another important change is that the licensed tax preparers who have not had at least 240 hours and 1 year of tax return preparation experience during the previous 3-year period must be under the immediate on-site supervision of more experienced personnel when preparing or advising in the preparation of tax returns. Previously, the rule was that first-year tax preparers could not be left unsupervised. But you could easily have, for example, a first-year tax preparer who worked 4 weekends during the tax season in their first year, and then you get into the second tax season and they're technically second-year preparers because they worked 4 days. Well, the board saw that that was probably a loophole that a lot of people might be taking advantage of to the detriment of the clients and the competency level of the preparer. So they have adjusted that rule and said now you are only considered to be an experienced tax preparer if you worked at least 240 hours in the earlier year. There's also some changes in here about getting inspections done on your business. If the board shows up to do an inspection on your business, you may not obstruct or intimidate the person who is there to do that investigation. Sisters is the second password of the day, SISTERS. And I'm just going to close out today's session with one other item which I think is absolutely crucial in every tax business. And I emphasize it so much because I've been doing this for 20 years, and in my 20 years I've supervised probably hundreds of tax preparers. And I consider supervision to be a very great responsibility. It's a great responsibility because I want my customers to get delivered accurate tax returns, and I want my tax preparers to know what they're doing. I want them to learn from their mistakes. But the only way my tax preparers can learn from their mistakes is if I am supervising their work. And the interesting thing is that the law requires that my tax preparers have their work supervised, but having done tax returns for as long as I have been doing them, I am very much aware that most tax preparers do not get supervision the way they're supposed to. And this is just based on people talking to me and telling me what goes on in their companies, and they're telling me my tax returns are not getting reviewed. And if they're telling me that, well, it's probably true. So I like to go into what it means to have supervision and the actual definition of that. And if you're a tax preparer working in an office where you are not being adequately supervised, that would be something to talk to your manager about. And if you're really feeling uncomfortable about the level of supervision, then that means that your supervisor or your employer may be out of compliance with board rules, and you could actually file a complaint with the board. So let's take a look at what these rules are. It says that each principal and branch office must be under the management and supervision of a licensed tax consultant, and that supervision means the direct and immediate control of the licensed tax preparer by the licensed tax consultant in such a manner that the LTC is aware of the line of questioning and reasoning applied by the LTP in the preparation of each return, and that the LTC has adequate opportunity to correct or add to the reasoning applied by the LTP. And there needs to be a system of selecting, training, and controlling the LTP, including a set of procedures by which the LTC is assured that the LTP is providing competent workmanship and abiding by the statutes and board rules. Such procedures shall include an examination and review of all personal income tax returns for errors under the direct supervision of the LTC, or the LTC can choose an LTP based on superior levels of experience and reviewing ability of that LTP. Also by giving notice to the LTP of any adjustments after examination and review. So what this board rule is saying is that if you're an LTP, the LTC or someone who is experienced enough to be able to review must review every single return you prepare. And if your returns are not being reviewed, then your employer is out of compliance with Oregon law. And here's the thing about review. If someone is reviewing your work, then they're seeing what you're doing wrong. And if they see what you're doing wrong, they can educate you on it. And if you get educated on it, then you stop making the mistakes. The flip side of that is that no one tells you when you've made a mistake, and you can go on for years doing it wrong over and over and over again. The Oregon Tax Board every year has a pass rate on the LTC exam of between 25 and 30%. This is for individuals who've worked a minimum of 2 years and 780 hours. And the LTC exam does not really test much different information than the LTP exam. It's just that it requires a higher level of understanding of the law. But the law it requires you to understand is essentially the same law that you're required to understand for the LTP exam. So those statistics tell me that preparers are not learning on the job. And because they're not learning on the job, they can't pass that higher test. And one of the key things to learning is to have someone look at your rework. So moving on, the very final conclusion at the end of all of my Oregon updates, I say if you are a tax practitioner and you have questions or concerned about ethics issues, who do you go or where do you go to? You can express your opinions to the tax board in writing or via email, or you can actually show up at one of their sessions and actually make a public comment in front of a room of people. And I've done that more than once, made public comments in front of rooms of people. So don't feel shy or abashed about that at all, but if it's not your personality, then by all means write a letter, and the Oregon board will examine the letter. And you can send your letter, if it's regarding ethics violations, to Monica Walker. And if it's just a general comment, then you could send it to Ron Wagner, and he is director of the board. So that concludes our class. I see we did run 15 minutes over. My apologies for that, but hopefully you found it worthwhile. Are there any questions for me? I do see one question here from Karine Gabrielle. Is it possible to extend property tax forms that gives the client or the tax preparer until April 1st to complete the forms without penalty? I've done this for Jackson County. Well, I've actually never personally attempted to file a personal property tax extension. What I have found, Karine, is that by the time I even see it, it's usually too late because the extension is due by March 1st. But they do have a little bit of a grace period that if you get it in with a certain number of days, the penalty is not assessed. And I've really only ever had one client come to me and complain that they did get a penalty, and that was a fellow who did not get the report filed until, July. And then by then they gave him a penalty. So Karina is saying that you can file these extensions. Just check with your county. Our firm files a bunch of these. Thanks for the information. If I need to do that myself, I certainly will, and it's probably a good tip for anyone else who tunes in and watches this session. I know that the number one question most of our new attendees have is, okay, how do I print my certificate of completion now? So I'm just going to share my internet with you a bit and show you how to navigate in there and print your certificate of completion if you do not know already how to do that. So this is our website, and to log into the Learning Management System, or LMS, you click the LMS Logon button. And then, of course, you need to log in. I'm already logged in, but if you're not already logged in, you need to log in. And then you scroll down to the course you're listed in. You can see I have a lot more courses than probably you do, so I have to go down a long ways. But when I get to the point where I've found the course that I'm enrolled in and that I want to print my certificate for, I click on the name of that course. And typically the first page I'll land on is the landing page, but sometimes I may have been on another page, and when I return, I go back to that page. But here's the landing page. The owl points out instructions on how to use the system. So always look to the owl for instructions if you're feeling confused. And then, of course, the Session Manuals tab, you click on that. You go to the File Cabinet drawer, and there is the document. It is loaded as a PDF, and you can print it. Under the Forms and Publications tab, most of our courses tell you to print forms or publications as a part of completing the course, but this course has no forms required. We have the Join Webinar tab with instructions on how to join. Underneath the Test tab, this is where you're going to go to take your Oregon Password quiz. And if you're a self-paced online student, you are also going to need to take an Oregon quiz on the content of today's class. So webinar students take only the passwords quiz, and self-paced online students will take the password quiz as well as an additional test that has between 10 and 15 questions in it. Answer keys, this is where you go to print answer keys for the test. And we haven't loaded any yet today, but probably by early next week we'll have the quiz loaded and the answer key to that quiz. The quiz is, or the answer key to the quiz is password protected, and to print the answer key, you need to get the password from the certificate of completion. And to print the certificate of completion, you go to the Completion Certificate tab. There is a survey in the middle of the page, and underneath the survey is a link to click on the certificate. The certificate will only open if you've passed the password test, and if you are also required to pass the quiz, you must have passed it. The password test has a 100% passing score, and the quiz has a passing score of 70%. Once you've passed required tests, click on the link. The certificate will open. You can print it and retain it for your records. In addition, in the lower portion on the very bottom towards the right-hand side of the certificate of completion, a password is printed, and that is the password you can use to open the answer key to the quiz. If you have any questions about the content of today's class, you can post a question in the Q&A forum, and we receive an email about an hour after you've posted your question, and as soon as we're able to respond, we will respond. So that concludes today's lecture on the 2011 Oregon Update. Thank you for attending. And I do see a comment here, will my certificate print if the manual wouldn't from my computer? That I can't answer. I understand you do have a technical person there to help you. Some companies have such high security systems in place that it's impossible to do much without having some security preferences put in. As a general rule, people do not have problems printing anything from our system. So if you have to go home and print it from your home computer or go to a library and print it there, you can. Or if you have tech people on site who can undo some of the protections that are in place, then it should work. Thank you for attending our class, and we look forward to seeing you again at our CPE sessions as they start in the spring. I'll be teaching probably 2 classes a week beginning in May, and those will probably go through as late as July, just depending on the schedule I set out. And that schedule will get posted on our website sometime in the next couple of weeks. And anyone who's interested in CPE programs can go check our website for the dates and times of each session. Thanks for attending, and again, I'll see you soon. Bye-bye. Oh, and good luck for the tax season.